Cost of capital. That's like one of the most important things that you want to think about when you're looking to fund your business. And we're going to talk about that in the episode today. All right, we are back with another episode of Wealth Building Made Simple with Allison Rife Martin, CPA. How's it going, Allison?
As we now start to all get our tax documents, because January 31st is like but a week away, are we thinking, good God, should we focus on, are we on track with our business so far? Or do we want to go for the squirrel of the tax return? I think it'd be more fun today to talk about if you're going to grow your business, what are the two ways you can do it, debt versus equity.
Alrighty, so let's get into debt. What is debt?
Basically you owe somebody money is the big long, so say you loan me $5 today, so that I can go out and buy a hamburger that I will eat Tuesday. Um, anyway, that's a silly old joke that's just a silly joke. But basically, your expectation is I'm going to pay you back $5 plus some semblance of interest. That's what debt is. I'm borrowing something from you with the expectation that I can repay it to you plus some semblance of interest. So, if we put it down to what's on the balance sheet that would be considered debt, it would be a credit card. It would be accounts payable. Like I owe my vendors for something, whatever I use for my service. I took out a mortgage for the investment in a building or a real estate property or just a long-term loan so that I can use it to grow my business. For example, like a lot of business owners took out the EIDL loan during times of COVID. So that's the Economic Injury Disaster Loan
Mm-hmm.
program. Um, the government expects you to pay it back with interest, or you go to a bank, or you go to, like a third party lender kind of a thing. But in the end, you owe it. You need to pay it back. You need to make sure that you can pay it back before you take it out.
Mm-hmm.
So we were talking about what are the advantages and disadvantages. Debt has lower cost of capital. The other thing that's selfishly for a lot of business owners, you don't have, it's different than equity in that I'm just beholden to the bank. I'm not beholden to other third party investors who now have a vested interest in the success of my business. I'm not giving up control of how I run the business if I'm solely focusing on debt. So that's one kind of emotional thing to think about when you decide debt versus equity.
And I want to drop one more thing here in debt too. This is just my thought that I'm planting in here. I think the realization a lot of people are waking up, um, us finance nerds are going, oh, cash is also another form of debt, meaning meaning cash in the bank is just a token for a debt-based system, right? Like the dollar is a debt-based system, and what I mean by that is um, uh, the interest that we pay is in the form of inflation, right? I mean,
Mhm.
and so when you think about it from that aspect, you go, okay, I need to think about how I finance my business as well, because if I keep $1 million in cash earning 5%, but my cost of keeping the money in the system is 10%, then you see why businesses that take care of their balance sheet and cash flow statement get richer, because they are looking at the financing cost of holding cash, right? I just want to throw that in there because we've been talking about these concepts, and a lot
Right.
of, a lot of business owners have cash and they're going, yeah, there's no cost to cash, and there's a cost of cash. And if you
There is a, yeah. How do you invest your money? And so like if you can invest it in a savings account, you can invest it in a money market account, you can invest it in a whole multitude of ways to do it to make money. So like you say, the cost of inflation is really a drag on the amount of cash you actually have. So that's the kind of things you need to focus on too when you're taking out loans. Really, what's my true cost of capital to do it? Um, but again, the nice trade-off with doing debt, I don't have to give up control of my business. If we
Absolutely.
move if we move into equity, obviously equity means like I myself am investing in my business. And if I need a little bit of help, I would go maybe to you and say, hey, Philip, would you like to be an investor in Rife Martin CPA? And, I believe that I'm going to be able to generate, I'm not promising you a 10x return, but I believe I can based on the direction that I'm going. And you might think, huh, that's awesome. I think I will invest. So you invest, we become partners. This is great. But the downside to it again is now you have a vested interest in getting your 10x, what I believe is my 10x return. Again, I haven't promised it to you, but at a minimum, you want your investment back. So you have a real vested interest in that I'm successful. Now that means you're going to start paying attention to how I'm running my business. And if you don't believe I'm going the right way, you can say, you know what, Allison, you are doing a terrible job. Or we're going to try something different. So there's a whole bunch of emotional things you need to think about before you invest in, you bring on a partner. I'm not saying don't, just think about it.
Yeah, I heard. I'm listening to a podcast right now. Like I'm not done with it. It's one of the greatest finance minds of all time, Michael Milken, and uh,
Ooh,
and to tell you how smart he is. Like when you hear about T. Boone Pickens, Carl Icahn, like the great financiers of the day. Um, they all got early money from Michael Milken. There's 72 private equity funds that are well known. They all worked for Milken back in the day. Like he's like the genius financier of our time when it comes to credit, right? Even like Howard Marks, who is the master of high yield markets. So I'm giving the background of saying he's a genius at credit. He's amazing. But what he said was he said, yeah, one of the tenets that I taught my people was like get money when you don't need it because it's cheaper, but when you need it, it's more expensive. And I was like, man, that just makes so much sense.
yeah.
Like
I
you.
was going to say he's certainly a sharp mind, but he had some questionable practices because, and
Yeah,
especially
yeah,
with like high yield bonds at the time. And so you're right about how he does it. There were just, he didn't necessarily follow some of the
yeah.
rules on
He
how to
he
do
he
it.
had he
So
had he had what do you call it? He had high intelligence, maybe like low patience, right? You have to balance your genius with patience because if you don't, then you can maybe get yourself into some questionable
exactly. So he's
situations.
got, but yes, he absolutely is certainly a genius, but he didn't necessarily want to wait. He didn't have the patience to follow the rules and got some people in trouble doing it. So
Yeah,
anyway,
yeah, yeah. Um, but yes,
so
but yeah. So that's so it ties into what you were saying about like debt equity, right? Equity being an option, but it's the equity or your debt. I feel like would be expensive if if you need the money, which sounds crazy, right?
right, yeah, you should. But that's again goes back to the idea of what we have said before is if you're reading your financials on a regular basis, you should know if you really need the money.
Yeah.
And you should never need it. You should want it because you
Mm-hmm.
need help to grow some aspect of your business. Like I need this extra piece of equipment because, in order to serve my customers better. So again, you should
Yeah.
never, and maybe again, you should never need it. You should want it.
Yeah. It's more like
And
listen. It's more like I'm sorry. Go ahead.
and you should be able to figure out how you can pay it back.
Yeah. Yeah. No, I think about it going. At this rate, I'm gonna be worth a lot of money. But if you give me money, we're both gonna be worth lots and lots and lots of money. In the
Right, exactly. And again, when you think of like thinking of equity, pick your partners carefully to make sure that you really both are aligned with the goals. So again, if I have a compelling story to tell you why you should want to invest in me, but we want to make sure that we like working together, that, you're going to be, we're going to be good partners for each other, and I'm going to, work my hardest to deliver on returning the kind of investment that I believe that I can do, so that we both have a successful partnership working together.
Absolutely. Absolutely. Well, let everybody. I'm sorry. I didn't want to cut it
Oh
off.
no, I was going to say this is, I think I love talking debt and equity. And it's one of those, again, you have to just put the emotions, you have to take emotion out, but you have to be thoughtful about, don't be so quick to take the venture capital money or the third party investor or the friends and family because, you know, if mom loans me money, mom wants her money back.
Mm-hmm. Yes, yes.
And she'll be like, hey, Allison, I really am not sure this is a good idea.
Exercise patience, right? Exercise.
Exactly. Be patient and look at your financials regularly so you know. So anyway, but I know you were going to say if everyone wants to reach me, how can they get in touch with me?
Mm-hmm.
Go to my website, rifemartincpa.com, or email me at info@rifemartinaccounting.com.
Thanks for sharing, Allison.
Yeah, thank you very much. This was a great episode.
Philip Washington Jr. is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.